70% of all the inheritances are lost by the second generation, meaning none of that inherited wealth ends up going to the third generation. 90% gone by the third generation. So this is just hard facts. So you've worked your whole life to build this financial legacy for you and your family. And really, how can you be sure that the next generation is going to use it? Be good stewards of that wealth that you've created to provide for your descendants. So Dynasty Trusts are one option. So they're an option that many of our clients use, not all of them. And many of these Dynasty Trusts are effectively incorporated into estate planning. And so we'll talk about that a little bit, into your living trust to a certain extent. Hi, this is Jim Cunningham. Today, we're going to talk about Dynasty Trusts, not just for the super rich. These are planning strategies that are available for normal people. And as we go through the materials, you're going to be like, well, that's really cool, right? Good stuff. So this is kind of a weird thing. You spend your life accumulating wealth, and I'm kind of at that middle point in my life. I'm in my, I guess I'm in my mid 50s now. But a really weird thing is 70% of inheritances, 70% of all the inheritances are lost by the second generation, meaning none of that inherited wealth ends up going to the third generation. I'm Jim Cunningham. I'm a partner at CunninghamLegal. I've been a lawyer for over 25 years, close to 30, truth be told. Offices throughout California. So I'm a certified specialist in estate planning, trust and probate law, real estate broker, securities and insurance licensed, and a pilot, a third generation pilot, and a second generation lawyer. These are the lawyers in our firm now. We got lots of lawyers devoted to helping people with estate planning, helping people with real estate matters, helping people just generally the mass affluent people with their family and financial affairs. So subscribe to our YouTube channel. This is really important. If you subscribe to our YouTube channel, this pops up in your feed, and we do these webinars pretty much weekly, and they're released on YouTube. So it's a great way to stay on top of all the changes in law, because the area of law that I'm talking about here is in a state of flux, and I think it's changing a little bit more rapidly than it has in the past. So this is a disclaimer. I'm a lawyer. I'm talking. Words are coming out of my mouth. This is not legal advice. So I don't want you to, watch this, think I'm talking to you, think there's an attorney-client relationship, which there is not, and then go out and do a bunch of stuff because you saw me talking on a video. Really bad idea. You need to work with a lawyer. So what is a Dynasty Trust? It has nothing to do with the series from the 80s. What is it? Who's it for? What's it for? Now, you can put up to $12.92 million in 2023 into a trust. So this is a lot. We're talking a lot, right? And there's no transfer tax. There's no gift tax by transferring $12.92 million. Now, the reason people have a Dynasty Trust is it's a longer-term trust designed to pass wealth from generation to generation to generation, to protect that wealth and to keep it from being taxed in the federal estate tax and state death tax structure. Now, I use the term death taxes, not in a political sense. The term death taxes I'm using includes federal and state inheritance taxes and death taxes. So, Oregon, Washington, they have some pretty high death taxes. So we include those in our term of death tax. As long as those assets remain in this Dynasty Trust, they go from generation to generation to generation. No gift tax, no estate tax, no generation skipping transfer tax. Now, you might ask yourself, what the heck is that? We'll talk about that a little bit later. But basically, if you leave a big pile of money to your grandkids, the government says, not so fast. We're going to tax it as if it went to your kids first and then your grandkids. So it gets taxed not once, but twice. That is the generation skipping transfer tax. These are irrevocable trusts, and I would say generally an irrevocable trust cannot be changed once it's created. So you can kind of think of this as being set in concrete, and so it's kind of a big deal. So you really need to be thoughtful, measure 19 times, cut once. You really want to be careful with this, and you really want to get an expert lawyer. You don't want to go to a novice, or do not do this yourself. That's a really bad idea. Anyone who wants to grow wealth over the generations, you should take a look at this. So let's look at Otto. Otto in 2023 creates a Dynasty Trust and puts in $1 million, right? And the beneficiaries are his 3 children. And a lot of these are written so that if you're Otto and you're setting this up for your kids, a lot of times this money isn't going to the kids while you're alive, right? It's there for future generations. It's there when you're gone. And many times we'll set this up as a common, or what is called a pot trust. has nothing to do with cannabis. It is just like a pot, like a kettle. So everything's in one pot. The idea here is it's kind of simpler to administer, gives you less headspace, less day-to-day problems. And then when Otto dies, the property is divided between the 3 kids, and each kid gets a third in their own trust. And this property passes free of estate and death taxes. And, if this property goes from $1 million to $5 million, which is not uncommon, if Otto's in his 50, it might be $5 million when Otto dies at 100, right? This avoids death tax, and that saves, after 2026, the death tax rates are going up to 45%. That would save $2.25 million in tax. So kind of a good deal. And then we have Owen. By the way, O is, in law school, we say Owen is the owner. Typically the people who have stuff and they're giving it an O, you can think of owner. Owen creates a dynasty trust and puts in $12,920,000 in 2023. So Owen's got a lot. He's able to commit this to his children and future generations. And again, the beneficiary owns 3 children in a common trust. When Owen dies, the property is then divided. This, let's assume this 12.92 million grows to 37 million. That's going to save $13.5 million in death taxes at Owen's death. This does not count the kid's death, the grandkid's death, and so on. So kind of a big deal. So if you're a higher net worth person, if you've got a $50, $100 million estate, you really should be looking at this. Okay. And if you have a $30 million estate, this is kind of, or 20 million, this is where a lot of our clients are doing kind of what Hal and Wanda do. So Hal creates a dynasty trust and puts in $12.92 million. The beneficiaries are Wanda and the 3 kids. So this is the spousal lifetime access trust version of a dynasty trust. So you can actually have your spouse be the beneficiary. A little bit more complexity in setting up, but at least that money's just not gone, so that Wanda is the beneficiary of that. So when Hal and Wanda go to Tahiti on vacation, Wanda picks up the tab from their trust. It's a for example. So if Wanda needs the money, Hal's effectively accessing it through Wanda, although Hal is not a beneficiary. He cannot be a trustee. He's got to have no connection with this. So when Hal and Wanda die, the property is divided into 3 trusts, and then the property passes free of death tax, again, saving $18 million in tax. What kind of people create a dynasty trust? What do these people look like? Well, these are people with a multi-generational mindset. I would say, you have to have some wealth, but really these are people who are thinking multi-generationally. I want my grandkids to inherit, right? I want my great-grandkids to benefit. And it is also asset specific. So if you have real estate or you have other kind of bigger assets that are kind of hard to divide, you might have a family-owned company. It's not a bad idea for a family-owned company, the shares of that company, to be in a dynasty trust. So these are for people who view wealth as a resource for you and your children and future generations. And really, it's kind of like a locked treasure box. So it's this, you can think of like an old pirate treasure chest with like gold coins in it. And this is locked. It's protected. It's protected from the government. It's protected from a lot of things. Protected from your great-great-grandkids' divorce. Maybe not a bad idea. And this necessarily includes estate planning for more than one generation. So a lot of lawyers, frankly, aren't trained to think in multi-generational terms. Okay, let's avoid probate. Let's get the property from here to there, to the parents to the kids. And then there's really not a whole lot of thought after that. So that's something we focus on in our firm, is multi-generational planning. And the people say, this isn't for me. Great, then don't do it. But we also focus on the multi-generational planning. So this is multi-generational estate planning. So it's not just about minimizing probate and minimizing taxes. It's about creating this lasting legacy. And I will also say this is appropriate for people who have, and a lot of times this is written in a living trust. If you have a child and that child is a lot richer than you are, and this does happen, right? Many times we set up these estate plans for the parents who may have a modest estate. It's set up in a trust so that inheritance stays out of that wealthy child's estate when that wealthy child dies. So it's used not only for wealthy parents, but also wealthy people who would be inheriting from you. So again, 70% of people lose their wealth by the 2nd generation, 90% by the 3rd. And having family wealth and preserving family wealth are 2 different things, right? And it kind of reminds me of that Indian fable that a man had successive relationships with 3 daughters. The first was envy. The next one was fear. And the final one was regret. So it's, I want this. Now I got it. I'm afraid of losing it. And then at the end of your life, you kind of regret that you kind of went through that whole process to begin with. But this is really part of that, is making sure that it's protected. Okay. This requires very careful and very considerate planning. And people who care about preserving wealth for future generations they use a dynasty trust. So this answers the question, is this for me? If you don't care about multi-generational estate planning or multi-generational wealth creation, it's not for you. If this is something that you really are focused on and you really want to provide a lasting legacy, maybe your grandparents set this up for you. Maybe your great-grandparents set this up, and now it's your turn to kind of pay it forward and return that favor to your descendants. So there are significant threats to the preservation of multi-generational wealth. I think divorce is probably the single biggest threat. We had a question earlier on before we started. How do you keep a person who's going to be a recipient of this? How do you keep them from being, some loser on a couch in Maui, just being a trust fund baby? And if you're a loser on a couch in Maui, you're probably not watching this, so you're probably not going to be upset because you'll never see it. But the point is, how do you keep that from happening? I think that's a separate question, right? And there are people out there who it is their profession to help counsel people. And one of our channel partners is Ascent Wealth Management, and they have an offering where they help people learn about wealth and how to deal with it and not have it ruin you. I happen to be in our San Rafael office right now, which is in Marin County. Marin County has the highest average home price in California. If you look at a county, if you want to, if you're living in Marin County and you've got a son or a daughter who's a school teacher and they want to buy a house, you might need to help them out. And this is where this dynasty trust can come in. It's almost like a family bank. But really, we want to make sure that these dynasty trusts are protected from very common threats. Divorce, taxes is always a threat. Once you get over a certain threshold, it's going to be, taxes are a really big deal. Frittering it away is just kind of blowing it, right? And a basic living trust, in a sense, is a threat, because I think people might view a basic living trust as, hey, that's enough. That is not enough in California to preserve multi-generational wealth. That trust can only last 90 years. So after you die, maximum term 90 years, 90. Irresponsible heirs, again, people just being irresponsible, and or spouses, right? They can also drain it, and ex-spouses and lawsuits and creditors. But I think the single biggest one is divorce. So use of a dynasty trust can protect wealth for many generations. Again, it's a sort of locked treasure box analogy. This is also known as a generation skipping trust. Now, in our firm, we do not use this term when we're speaking with clients. A generation skipping trust implies that a generation is being skipped. The origin of that term, generation skipping trust, is it is a trust that is exempt from the imposition of a generation skipping transfer tax. Stated another way, a generation skipping trust is a safe zone where money can go into that trust and go from generation to generation to generation and not be taxed at each death of each beneficiary, is the bottom line. So very misleading. Whoever came up with that, probably a really bad idea. That's why people came up with the term dynasty trust, right? Generation skipping trust, very confusing. I would say this requires an expert lawyer. This is not for novice lawyers. This is absolutely not a do-it-yourself project. There are way too many traps, way too many income tax consequences as these things are created and administered or used over the years. So definitely want to go with an expert lawyer. Very few lawyers understand this. I got to be honest with you. 7% of lawyers practice in trust and estates. A very small percentage of that 7% even know what we're talking about here. You're going to have superior knowledge to many lawyers. So Hal and Wanda created Dynasty Trust. We're revisiting Hal and Wanda. They put $12.92 million in it. This money that goes from generation to generation to generation is protected from divorcing spouses, lawsuits, and irresponsible heirs, because that's how Hal and Wanda built it. And this is your choice. Most people want to protect this multi-generational wealth from threats. And if this is you have the ability to do this. It's great. So how does a dynasty trust work? What's going on? Again, this locked treasure box, the lawyer works with the family members, the family, to create this dynasty trust, and you move assets into this trust. Now, this can be done while you're living, and for some people, it's done when they pass away. Okay, so it depends on the context. Also depends on amounts. Depends on when people pass away. We'll see that the law is changing here in the next couple of years, and it's kind of a big change for wealthy people. So you want to pay attention to that. And you can put 12.92 million into this. Up to, it used to be $1 million. That was the most we could put in. It was $1 million until very recently. I mean, recently, like 10 years, right? 10, 12 years. Now you can put 12.92 million. If you're married, you can put 25.84 million. So almost 20. I mean, this is a very large number. So think about this. you know, you can set up a trust. And if you have a significant amount of wealth, you can set up a trust. If you put 25 million in there, what's that going to be worth in 50 years or 100 years? It's really mind-boggling. This is really an incredible opportunity over the next couple of years. If you're watching this and you're a wealthy person, you really need to get on this, because there are very few lawyers who know this. A lot of them are retiring. We're very busy. It's not even the end of 2025. If you wait till 2025, there may be no room at the inn, right, as it were. So from after the assets go into the trust, the Dynasty Trust always owns these assets, not the individuals in any generation. And this is very important. So there's no distribution to people. It's not like, hey, you reached 35, here's a big check. It doesn't work that way. This money stays in trust. The trustee maintains 100% control. So this is really where the element of protection comes in. That beneficiary, that person who's, maybe your descendant, does not have the right to take money out. It's controlled by the trustee. Then the trustee maintains that 100% control. But sometimes, you can be the trustee. The person making the gift, sometimes they can be the trustee and sometimes not, for a variety of reasons. And this is where it gets tricky. Is an attorney might write up a trust, and if they don't know the rules and they put the person who gave the money in as a trustee, that could cause real problems. So you want to make sure and hire someone who knows the rules and is really paying attention to the details on this. The trustee holds the key. So imagine this locked box is treasure in the box, money, investments, real estate, whatever it is. The trustee's holding onto the key, and the trustee is the one who's deciding. Now, if you decide to do a dynasty trust, and when you talk to the lawyer says you can't be trustee, that's a really big decision to make. Well, sometimes your spouse can be the trustee. Sometimes it's a trust company, and we'll talk about that in a little bit. But just bear in mind, you're not always going to be able to be trustee on all of these trusts. So, hopefully these trusts grow over time, and then the trust sort of distributes assets or lends money. This is another strategy, is treating it like a bank, right? I'm going to lend money. The trust lends money to a beneficiary. That way, if the beneficiary gets sideways with creditors, then that trust can say, well, hey, that beneficiary doesn't own the property. They might own it, but there's a lien on the property, so that money comes back to the trust. So these are all things that are kind of ongoing. And I'll tell you, if you're a wealthier individual and you're looking at this and you're like, wow, this might be for me, you really need to pick the right law firm, because you're going to kind of be, you're going to be attached to this law firm for a very long time. Many of the lawyers in our field are solo practitioners, and they really don't have a succession plan. That's not us. You saw the number of attorneys we have in our firm. We have a partnership track that's written, and we share that with the associate attorneys. So that's something we're going to be around, right? We're not going to just kind of wink out of existence. And I cannot say that for other law firms. You really do need that continuity. There's a significant amount of institutional knowledge, is the term, that goes into these plans. So who can serve as trustee? Who can be appointed as trustee, and who should be named, kind of who shouldn't, right? The trustee controls the keys to the Dynasty Trust treasure chest. People often use a trust company as trustee. Now, we've talked in other webinars the difference between a trust bank and a trust company. Wells Fargo, US Trust, those are trust banks. Trust companies are non-custodial institutions, meaning they don't hold on to your money. They're not running your investments. Those tend to operate a lot leaner. The fees are a lot lower. They tend to be more responsive because they're very typically smaller institutions, and they're located in states with no state income tax. So this is very important. So when you look at this trust, I would say if you're in California, we rarely write these under California law, I'll tell you, because you're likely going to subject it to California income tax. And California, the maximum term for these trusts, as I said, is 90 years. It's not very long. That's it. It's longer in other states, and we'll talk about that in a couple of slides. And the advantage of appointing an institutional or a professional or a trust company is they're not going to steal. And if they do steal, like if somebody embezzles in there, you're probably going to get your money back. I mean, there's no guarantees, right? But you're way more likely to get your money back, or way more likely to not have it stolen, than if you name your niece or nephew as trustee of some big trust. So that's just something to consider. And these can get complicated. Record keeping is important. And it definitely is worth, it's definitely worth investing. What you will see is a nominal amount of money when compared to the whole thing. So Hal and Wanda, they create their Dynasty Trust. They put in $12.92 million. And because Hal made Wanda a beneficiary, Hal cannot be trustee. That's just the rule. Hal can't be the trustee. He can't have any more involvement in that trust. So they would want to seek out either have Wanda be the beneficiary, or, you know, if they're California residents, we might want to write this up as a Nevada trust for income tax reasons. So deferring the state income taxes, at least until Hal and Wanda cease becoming California residents if they choose to. But at least you're deferring, kicking that can down the road on that 13.3% state income tax. Well, how long can a dynasty trust last? How long can, and part of this is like, how long should they last? Well, here's a picture of my great-great-grandfather. And he was Isaac Wilhite, born in 1842 in Tennessee and died in 1921 in Illinois. He mustered into the Union Army, serving in the 56th Regiment, Illinois Regiment, and fought under Grant in the Battle of Corinth, the Siege of Vicksburg, and other battles. I had an attorney work for me who's no longer with our firm. His great-great-grandfather was in the Battle of Corinth from New Orleans, and they fought each other, and his great-great-grandfather was killed. Mine wasn't. He lived till 1921. Now, here's the reason I'm putting this up here. I never met him. My grandfather, who was born in 1909, remembers talking to my great-great-grandfather. And I certainly remember my grandfather. So my point here is, what if Ike Wilhite had set up a trust and put $3,000 in the trust, which is $100,000 in 2023 dollars. I will tell you, $3,000 in 1892 probably seemed like a lot more money than $100,000 today. So what would have happened if it had gone into a dynasty trust? And we're going to talk a little bit about which jurisdiction to pick, because under California law, this trust would have had to terminate. But under different states' laws, it doesn't. Well, let's look at the numbers. At a 1% rate of return, $3,000 becomes $11,000. At a 4%, it's $511,000. At 7%, it's $21 million. And at 10.331%, which is the average return for the S&P 500 over the last 100 years, it is almost 1.2 billion with a B. Crazy, right? This is the power of compound interest, which Albert Einstein said is the eighth wonder of the world. Now, we're not talking about taxes. We're not talking about, but the point I'm driving home is the longer this money sits and the longer it accumulates, and certainly dependent on the rate of return, right? Then this can create a significant amount of family resource, is the bottom line. What is the best state in the United States for a dynasty trust? Is there a best state? Is there a worst state? I would say, in my humble opinion, these are the top four: Nevada, Alaska, Delaware, and South Dakota. Nevada's maximum term is 365 years. And let me back up on this. There's this thing called the rule against perpetuities. We spend 6 months on it in the first year of law school. Basically, it says you can't tie up stuff forever. You can't tie up land. You can't tie up property. You can't just put it in this trust forever, because over time, all the assets in the whole world would be in a trust, right? It doesn't even make sense. So what's happened is other states have said, well, we don't like that rule. We think it's okay that you can put money into a trust and just never have it taxed going forward. Now, I will tell you, if I was the federal government and I was looking at this, I might have a problem with it, because they're going to want their death taxes at some point, right? So this is what the law is now. It may not be this in the future, but something to understand is it matters what state you write your trust under what laws and where the trustee is. So Nevada's 365 years. Alaska is perpetual, but if a power of attorney is exercised, it's only 1,000 years. Now, power of attorney is something can be written into a trust that says, if my great-great-grandfather, Ike Wilhite, left me $1 billion or whatever, whatever the number is, I can say who gets that when I die, but it just can't be, my creditors or my estate, right? I could leave it to one child, but not the other. I could leave it to a spouse. I could leave it to charity, whatever that is. That's what's called the power of appointment. It's best understood as a power to disappoint, meaning these people are in as beneficiaries, but I can say, nope, you're not getting the money, somebody else is. Delaware is perpetual for personal property, but only 110 years for real estate. What does that mean? Well, most of our clients who have investment real estate, which a trust would have investment real estate, most of that real estate is in an LLC that then converts it to personal property. So there's kind of an easy way around this with Delaware. And South Dakota is perpetual. That's forever, folks. Perpetual. This money can just keep accumulating. And none of these states have state income tax. Now, there's a missing state here. There's a big state that doesn't have state income tax. And I'll give you a hint. It's the biggest state in the lower 48. What about Texas? This is a common question. A lot of Californians are moving to Texas. My parents moved to Texas as erstwhile California residents. Here's the problem with Texas. And if you're in Texas, I'm just gonna give it to you straight. There's no state income tax, but Texas has 254 counties. And the smallest county has 100 residents. The largest county is Houston, right? And that's Harris County. They've got over 4 million people. Here's the problem. I would be very uncomfortable going to a jurisdiction like Texas with all these counties and some of these tiny, tiny counties. They may not have adequate training for their bench officers. Now, what a bench officer is that's a judge. That's a maybe justice of the peace, whoever you're going to get. A county of 100, I don't know. Is a dog catcher going to be judge? And if you're in Loving County watching this, I mean no offense at all, okay? But my point is, this is one reason that publicly traded corporations use Delaware, because the Delaware judiciary, the bench officers in Delaware, they have 3 counties, by the way. They're very well versed and very well trained in corporate law, and they have very robust corporate law, so you have more certainty. So I'd say these other states here that we have, there is more certainty with South Dakota, Delaware, Alaska, and Nevada. I would say you're not getting that in Texas. So I would just, it's food for thought. So Howland wanted to create this Dynasty Trust, put in $12.92 million. Hal's lawyer writes the trust under Nevada law and names Premier Trust, who's a Nevada trustee who we use quite a bit. You might have heard of them in prior webinars, to serve as trustee, and the trust can continue for 360 years after Hal's death. That's a really long time. And that's why I brought up this issue of my great-great-grandfather, and that was, 130 years ago. 360 is a long time. 1,000 is a long time. It's really how long is too long. Now, this should say South Dakota. In South Dakota, it's forever. So how long is forever? I don't know. So how long is too long? It's a question, but I would say California is too short, right? The other way to ask this is how long is too short. I probably wouldn't be using California for these long-term, these longer-term trusts. So let's look at tax benefits of Dynasty Trust. Oh my goodness. I love my misspelling. Tax benefits of Dynasty Trust. All right. Deferral and avoidance of state income taxes. Done correctly, assets that are moved into a Dynasty Trust can be free of state income tax and capital gains tax, okay? And these can be powerful tax reduction strategies. Now, it's something to understand. A lot of times this is a deferral. So if you're a California resident and a Nevada Dynasty Trust and you're incurring capital gain and income and you're not distributing those assets, if they are distributed to a California resident, California is going to want that California resident to pay the taxes on that. So it's at least the law as it is now, but that might give time for the California resident to move to Florida for 3 years, right? If it's a lot of money, Florida doesn't have state income tax. Nevada doesn't have state income tax. Maybe you move to a jurisdiction and then you move back to California. And this creates, this avoids, again, estate, death tax, and generation skipping taxes, but only if done properly. And this is very, very important. If it's done incorrectly, it causes inclusion in somebody's estate, which is a really bad word, causing inclusion in a person's estate, meaning that when that person dies, these trusts can be written, if they're kind of not written properly, all those assets or some of those assets could be included in somebody's estate and you have to pay tax. So a Dynasty Trust typically files its own income tax return. It's a 1041. If you have over a threshold amount of income, you're going to have to file the tax return. And sometimes the person setting up the Dynasty Trust is the one who has to pay the tax. So let me say this another way. There is a way to write a trust where you give away $12.92 million. And when that income tax bill comes due, even though you've given away that money, you as the donor, the person who gave the money, still pay the income tax. Now, you may tell yourself, that's the dumbest thing I've ever heard. Why would I want to give something away and be liable for the tax? Well, depending on your level of wealth, if you're a wealthy person and you're going to pay, when you pass away, there's death tax to be paid. I would rather be paying all that income tax if I'm the donor from my pot of money, because that reduces my overall estate. Because the people that you're making gifts to likely are in the marginal tax bracket anyway, okay, if your estate plan's written properly. And so a lot of this is tax bracket arbitrage. It's making sure that the person who is making the gift, if they still have significant assets that would cause a death tax when they pass away, that you reduce that estate by paying taxes. It's effectively a backdoor gift for free, right? Those are rules that both the Obama administration and Biden administration want to undo, by the way. So if you have one of these trusts, you're likely grandfathered in. And if you got to get this in before the law changes, and it may change, it may not, I don't know. I don't have a crystal ball. December 31, 2025, we're going to party like it's 2025, I guess. Then that is a big date, because that is when this expanded currently $12.92 million death tax exemption, the last day, right, that's around is that date, because the next day, January 1, 2026, death taxes not only go up for many, many people, so the amount that you can leave tax-free is reduced, so that subjects that assets that weren't otherwise taxable as being taxable. Not only is the amount that you can leave as a freebie reduced, your death tax rate goes from 40 to 45%, the federal estate tax rate. Very important to pay attention to that, because these numbers are changing. Those are due 9 months after death. And if you don't pay, you got to set up some payment plan with the IRS and pay interest, okay? But they're due under some circumstances, you can do a payment plan. So these are the 2017, the Trump Tax Act. And I say that not in the political sense, but to identify when it happened. It was during the Trump administration. And we're kind of estimating this will be cut to about $7 million, which is $5 million in 2011 adjusted for inflation. So if you shift sizable amounts to a dynasty trust, you can take advantage of these gift tax exemptions now. And again, as I said, the tax rate's going up from 40 to 45%. So if you're kind of on the fence on this, I'd get moving on this. I'd start the process pretty quick. This takes many of our clients like 6 or 8 months to set up. This is not something that happens overnight. It happens over time. So again, if you wait till the fourth quarter of 2025, I don't know that anyone's going to be able to help you, right? It's going to be a tough one. So once these assets are transferred to the Dynasty Trust, they belong to the trust, not your estate. So there's no estate tax. It's not in your estate. You have made that gift to the Dynasty Trust. Generation skipping transfer tax. What is this? I mentioned this a while ago. Generation skipping transfer tax says, look, if you're wealthy and you skip a generation or you leave it to somebody 37.5 years younger than you, I don't know where they came up with that, then you are taxed twice on that money. So what do I mean by this? We'll give an example. So generation skipping transfer tax. Let's say grandma leaves $22.92 million to grandson. The first $12.92 million passes tax-free, no problem. The next $10 million is taxable. Well, how much tax do you pay? Well, the grandson's going to pay $10 million. On that $10 million, the grandson's going to pay $4 million in taxes. This is with our current 40% structure. It'll be higher in 2026. That leaves $6 million. But because it's a grandson, it's going to get taxed again 40%. So the total tax bill is $6.4 million on $10 million. This is why if you're wealthy, you must pay attention to this. People get trapped in this all the time, okay? And it's just a thing. Now, the generation skipping transfer tax is a bad thing. A generation skipping trust is a good thing, because we could take that $12.92 million and put it in a trust for grandson, so that when grandson dies and those successive generations, if it's a Nevada trust, it goes to 360 years, that'll never be taxed in anyone's estate. So if you're a wealthy person, this is something you should really be paying attention to. And if you're not, pay attention to it, because you could put $1 million in there and it could be 10 million when you pass away, then 100 million when the next generation passes away. So, this is not just for super, super rich people, but over time, this can become a really big, a really significant dollar amount. So Hal and Wanda create a dynasty trust, and they save $2.9 million in death taxes because they set this up now instead of later. So a great use of it. I'm going to cover something. We'll take a few questions. And before we talk about discounted valuation, which sounds really boring and esoteric, but it's a way where you can give more than 12.92 million. What the heck is discounted valuation? Knowledgeable attorneys know how to compress value of certain assets. Typically, these are going to be real estate, privately held companies, not marketable securities, not cash. You can't do it with that. You can transfer more than $12.92 million without incurring gift tax. Now, it's not uncommon to get a 35% discount for certain gifts. Sometimes it's 15, sometimes it's 5, sometimes it's what. I'm just giving you a concept, okay? And don't look at this and go to the bank and say, well, Jim said it's 35%. No, I'm giving you a for example, because kind of the math works. So Hal and Wanda have extensive real estate holdings and put these into an LLC structured as a partnership. So they might have a holding company and other LLCs, but on the high level, this is a partnership structure. So an LLC can be, and we've covered this in other webinars, can be taxed as a corporation or a partnership, but this really, you should be doing this with a partner in a partnership structure with real estate for a variety of reasons. Hal creates a Dynasty Trust in 2023 and gives $19.88 million worth of partnership interests in real estate, but is only taxed as if it's 12.92. This saves $2.8 million in gift tax. Now, Hal and Wanda and their 3 children are beneficiaries of a common trust. And then at the death of Hal and Wanda, the property is divided into 3 separate trusts. This property passes free of death tax. And even if the value of the trust is increased to 70 million, so it doesn't matter where it goes. But this is really important. What's going on here? Well, there are discounts for lack of marketability and lack of control. So if I have a fractional interest in real estate, then, and I can't sell it, right? And I'm receiving this, the government provides for a discounted valuation, discount for lack of marketability and lack of control. This is very well documented in secondary source materials. It's very well documented. People have won and lost cases at the IRS. You know, pigs get fat, hogs get slaughtered. So we rely on the valuation experts. And so, you know, this is not, you just set up an LLC, put the property in and make transfers. No, you have to go through a lot of due diligence, right? You're going to have to get valuations of the underlying real estate, valuation of the partnership or the partnership structure, and then valuation of the individual interest. That is not cheap. That is not a small amount of money. You're going to invest a significant amount of money to save, to make those savings, right? So this is a freebie. It's an extra $6.46 million per person until 2026. It saves $2.9 million at death. By the way, this $12.92 million that's getting cut in half is a use it or lose it proposition. Again, January 1, 2026, everything changes. I would say if you're looking at this and you go, I really like that, that's really interesting to me, you need to start on this now. Don't wait a year. Don't wait 6 months. Don't wait a year and a half. All the lawyers I know who do this, they're all busy. And again, it might be a situation of there's no room at the end. And these take time. Some of these take over a year to set up. And, you know, if you have real estate, you have to figure out who owns the real estate. What are the property tax issues? What about this LLC? What about that LLC? Where are the leases? Where's all the stuff that you've got to get together? And a lot of these things happen sequentially, not concurrently. So you can't do, you know, you do step 1, 2, and 3, and you can't do 4 until you're done with 3. And there can be a significant holdup. So is consulting with a lawyer enough? I would say no. I don't think this is just a lawyer. I think you need an A team of people. And we cover this in other webinars, your A team, right? A specialized California state lawyer. So this is a certified specialist in estate planning, trust, and probate law, absolutely CPA, multiple CPAs, maybe multiple firms for a variety of reasons, and your financial advisor. I kind of prefer the certified financial planner. I think they have an extra level of training. And if you're, this is really kind of 10 million is the cutoff, 5 if you're single, 10 if you're married and above. And if you're over 10 million, you might want to consider our firm's multifamily office services. It is really focused on reducing income tax year over year. And a lot of my day is spent talking to clients. You sell your company. You're like, oh, I didn't realize I have to pay $5 million in tax on my $10 million sale. What can I do to mitigate that tax? What can I do to defer it? What can I do to delay it and maybe pick up some tax credits? That's something that we help clients with on a daily basis. My book, Savvy Estate Planning, What You Need to Know Before You Hire the Right Lawyer, covers basic. This is like kind of not what we've been talking about as much, but it talks about concepts. It talks about, do I want to have asset protection for the inheritance I leave my kids, right? Yes or no? Do I want to pay less tax, right? What are these structures? What should I be thinking about before I even go meet with the lawyer? You know, what are the questions that the lawyer is going to ask me? So we covered that in the book. It's a great resource. We have office locations throughout Northern and Southern California. I happen to be today in our San Rafael office in Marin County, as I mentioned, but we do have offices in the LA and Bay Area and Capital Region. Next up, next week, this is really important, secrets of oil and gas tax subsidized investing. We've talked about solar a lot. We also talk about oil and gas. And you may think, Jim, why are you doing both? Like, that's crazy. Here's the bottom line. We need oil, not necessarily to burn and put in the atmosphere and our oceans, but we need oil to make stuff to live, right? And so oil is still an important part of the human experience here on Earth. and the government subsidizes it. Okay. So meaning there are tax advantaged investments where if you invest in oil and gas, you're not only going to get a return on your money, you're going to also get significant tax benefits that reduce your overall tax, your tax bill. So that's coming up May 18th, which is happens to be my mother's birthday. So we will be covering that next Thursday. Subscribe to our YouTube channel. It's really easy. You can click the bell and be alerted on anything, any new videos as they're posted. And if you're watching this on YouTube, just keep watching because another YouTube is going to roll up another video that I've done in the past.